Hello, friends. This is Martin speaking. Please watch this episode to the end. In this episode, we will discuss three very important topics: dollar dominance and China's appetite, the intricate dance of global oil markets, Biden's global chess move, World Bank reform to challenge China, yuan's plummet. Is China's financial stability at risk? Topic number 1. Oil prices experienced a decline, primarily driven by factors such as the strengthening U.S. dollar and concerns over China's economic recovery. Despite this, the decline was limited due to a larger-than-expected decrease in U.S. crude oil inventories. At 10:01 a.m. local time, 7:01 GMT, the international benchmark crude Brent was trading at $89.64 per barrel, reflecting a loss of 0.31% compared to the previous trading session. Similarly, the American benchmark West Texas Intermediate, WTI, traded at $86.52 per barrel, showing a decline of 0.4% from the previous session's close. These price movements occurred despite positive news regarding supply cuts by major oil producers, Saudi Arabia and Russia. The two countries announced their intention to extend existing output restrictions until the end of 2023, potentially reducing global output by approximately 1.3 million barrels per day for the remainder of the year. Alongside this, a significant draw in U.S. crude oil inventories further supported the momentum in oil prices. The Energy Information Administration, EIA, reported a decrease of 6.3 million barrels, or 1.5%, during the week ending on September 1. This draw exceeded expectations, indicating increased demand in the world's largest oil-consuming country. Despite these factors, the strengthening of the U.S. dollar impinged on upward price movement as it made crude oil less affordable for importing nations. The dollar index reached its highest level since March 9, closing at 105 on Thursday. This development raised concerns that the U.S. Federal Reserve, Fed, may continue to raise interest rates. Additionally, the Chinese yuan depreciated to a 16-year low against the U.S. dollar, reflecting growing pessimism towards China's economy and financial markets. This depreciation may have added to the downward pressure on oil prices. On the other hand, China witnessed a surge in crude oil imports in August as refiners accelerated their operations to take advantage of higher profits from fuel exports. Official statistics from China's General Administration of Customs revealed that August imports reached 12.43 million barrels per day, marking a 20.9% increase compared to July and a 30.9% increase compared to the previous year. In conclusion, oil prices experienced a decline due to factors such as the strengthening U.S. dollar and concerns about China's economic revival. Nevertheless, supportive elements like extended output restrictions by Saudi Arabia and Russia, coupled with a substantial draw in U.S. crude oil inventories, prevented a more significant downturn. It remains to be seen how these opposing forces will shape future price movements. What are your thoughts on this topic? Feel free to share your opinion in the comments below. Topic number 2. Biden's global chess move. World Bank reform to challenge China. President Joe Biden will attend the G20 summit in India with the objective of enhancing climate and infrastructure lending to developing nations. This initiative aligns with broader efforts by the United States and its allies to counter China's growing influence in Africa and Latin America. Before the summit, Biden sought approval from Congress for $3.3 billion in World Bank and International Monetary Fund financing, aiming to provide an alternative to Beijing's lending practices. Washington argues that China's financing terms primarily benefit Beijing, while often requiring access to valuable natural resources from recipient countries. The White House stated that increased World Bank lending would create a credible alternative to China's coercive and unsustainable lending practices and infrastructure projects. During the summit, Biden plans to advocate for debt relief for developing countries and propose reforms to the World Bank and other international lending institutions. As mentioned by National Security Advisor Jake Sullivan, both President Xi Jinping of China and President Vladimir Putin of Russia will not attend the G20 summit, opting to send their top diplomats instead. Nevertheless, the tensions between China, Russia, and Western nations will undoubtedly influence the discussions among the world's major economies. Putin's absence was expected due to the International Criminal Court's war crimes charges against him and his limited travel since the invasion of Ukraine. On the other hand, Xi's decision not to attend the summit was seen by some as a slight towards India and its Prime Minister Narendra Modi. However, Chinese Foreign Ministry spokesperson Mao Ning denied any connection between Xi's absence and the tensions between China and India, reiterating China's support for India as the summit's host. Russia also seeks to strengthen ties with India during the event. Modi has skillfully utilized the G20 summit to showcase India's transition into a developed economy, bridging the gap between affluent countries and the global south. As the host, India has invited the African Union, a coalition of multiple African nations, to become a permanent member of the G20. Climate change, food security, and other challenges impacting the global south will dominate the summit agenda. Manjari Chatterjee Miller, a senior fellow at the Council on Foreign Relations, emphasized India's successful utilization of the G20 platform, a move that has captured China's attention. While Xi's absence might convey the message that India lacks influence, experts like Samir Lalwani from the United States Institute of Peace perceive India as a potential power broker and a bridge between the West and the global South. With a population of 1.4 billion, India boasts the highest population globally, as well as the largest democracy. India's rising stature on the global stage has been bolstered by its deepening relationship with the United States under the Biden administration. In June, Biden hosted Modi for a state visit where both leaders announced new agreements covering defense, science, technology, trade, and other areas. This reflects the U.S. recognition that collaboration with India can help counter China, particularly in domains like artificial intelligence, according to Prashant Bhuyan, the founder and CEO of Accrete, a U.S. defense contractor and AI company. While hosting the G20 summit signifies a milestone for India, it also draws attention to the country's democratic setbacks and religious tensions. The ruling BJP party and Prime Minister Modi have faced criticism for allegedly fueling ethnic and religious divisions, leading to violent clashes in recent months. Moreover, India's stance on Russia's invasion of Ukraine presents a complex situation. While India supports Ukraine, it has refrained from openly condemning Russia due to concerns about its relationship with Moscow. India's reliance on Russian energy and technology for weapon systems contributes to this. Topic number 3. Yuan's plummet. Is China's financial stability at risk? The Chinese yuan concluded its domestic trading session on Friday at its lowest level since the global financial crisis, primarily due to pressures from capital outflows and a widening yield gap with other major economies, particularly the United States. The onshore yuan closed at 734.15 per dollar, marking its weakest performance since December 2007. The currency has been among the worst performers in the region, having depreciated 1% against the dollar this week and roughly 6.1% year-to-date, influenced by the strengthening dollar and China's sluggish post-pandemic economic recovery. Experts anticipate further selling pressure on the yuan in the near term. However, they believe that any losses will likely be moderate. In an attempt to stabilize the currency, the People's Bank of China, PBOC, set the midpoint rate at 7.215 per US dollar, slightly weaker than its previous fix. This move indicates that the PBOC might be allowing the yuan to gradually decline. Downside factors such as a widening services trade deficit and reduced incentives for Chinese exporters to convert their proceeds back to yuan due to a wider interest rate gap could continue to impact the currency in the short term. Nevertheless, analysts do not anticipate a significant shift in the yuan's value, as the PBOC maintains a strong stance to defend its current levels. Some experts suggest that the PBOC may take further action, such as state banks selling dollars in the market. The recent weakness of the yuan is not an isolated event, as factors like higher oil prices and solid U.S. economic data have also contributed to the strength of the dollar. Market participants are expecting a slowdown in the depreciation of the offshore yuan this week, as they anticipate a funding squeeze in the offshore market to alleviate the pressure. However, It is worth noting that the offshore yuan dipped to its lowest level since October 2022, reaching 736.21 per dollar. In an effort to contain the yuan's rapid decline, Chinese authorities have introduced several measures recently, aiming to instill more confidence in the currency exchange rate. As the Chinese economy gradually recovers, policymakers are emphasizing the importance of stability in the yuan. Now it would be interesting to hear your thoughts on this topic. What is your opinion on the recent decline of the yuan? Feel free to share your views in the comments section below.